This is a debrief for the business tax assessment, and in this video we're looking at sample assessment 1 from the AAT website and task 8. And task 8 is about tax planning and the responsibilities of the business and agent. So you can see on the screen that this is a task that requires written responses, and you may want to consider leaving this task until after all the numerical tasks. Many people can do the numerical questions perhaps a little bit quicker than normal, and therefore you can get those done, and then with any remaining time you have in your assessment, just write as much as you can for the written tasks. Basically, the more you write, the more ammunition you have for getting marks. So high volume can really help you to score well in these sorts of questions. So let's look at part A. Florrie has been trading for many years. She offers her customers a small discount if they pay in cash, and she does not include these cash payments in her accounts or tax return. So part A, part 1 asks us to define tax evasion and tax avoidance. So tax evasion could be defined as illegally paying less tax by either falsifying or omitting records. So it could be that we might underdeclare our income or overstate our expenses so that we have less profits and therefore less tax to pay. But essentially we're lying to HMRC about our position. So a definition of tax avoidance could be legally paying less tax by following the letter of the tax law but not the spirit of the law. So effectively we're using loopholes in the legislation to allow us to pay less tax, but it wasn't really following the intention of the legislation in the first place. So an example of this might be a business giving a loan to a director, and then the director can use that loan for whatever, but by classifying it as a loan, that's not taxable, is it, compared with having a salary? So this is allowing them to pay less tax, but it's a legal way of doing that. Now this question doesn't ask us to define tax planning, but while we're talking about these, let's revise that as well. So here's a definition of tax planning. We are legally paying less tax by following the tax legislation as it was intended to be followed. So we're perfectly allowed to do this. We're paying less tax because that's what the government allows us to do. So for example, if we give donations to charity, then we pay less tax, and that's perfectly allowed. Then in part 2, the question says identify whether Florrie is committing tax avoidance, tax evasion, or engaging in tax planning. Well, what is she doing? She's offering her customers a small discount if they pay in cash. Well, that's perfectly legal. That's fine. Yeah, to get that cash up front is good for the business. So we may be willing to give a discount to incentivize our customers to do that. But what she's doing though is not including these cash payments in her accounts or tax return. So in this case, she is falsifying her records, and therefore that would be tax evasion. Next then, Sabrina is the sole trader and director of a small company, Sabrina Limited. She has no employee and takes a salary during each year of $55,000, which is deducted in calculating her trading profits. The remaining profits of Sabrina for both tax and accounting purposes are expected to be $40,000 before corporation tax each year. Sabrina also has a dividend income from investments of £5,000. She is a higher rate taxpayer. So you need to calculate the maximum additional dividends Sabrina will be able to take in the year ended 31st of March 2025. So from a tax planning point of view, we can look at note 1 in the reference materials. It tells us Sabrina is a higher rate taxpayer. So what we could do, we could pay her more salary from the profits, but she would be taxed at 40% on that salary. The alternative would be to pay her dividends after the profits have been taxed, in which case she would pay 33.75%. So it would be better for her to receive dividends than to give herself more salary. So that's the background to what this question is asking us about. So that bit of information isn't key to answering this question, but it's just helping us to understand the situation in general. So it's asking what's the maximum additional dividends she'll be able to take in the year. So the government says, the law says that you can only pay dividends from our profits. We can't pay dividend from profits that haven't been earned yet. So we're told that she has 40,000 of profits before corporation tax has been deducted. That's not a very large number, is it? So if we look at section 4 of the reference materials, so there's our lower limit. So we can see that her profits are below the lower limit, and therefore, as she's small, she can use the small profits rate of 19%. So what we can do then is take the 40,000 of profit and deduct that 19%. So we want to multiply by 81% because that's 100 less the 19% tax rate. And that would mean that after paying the tax, that Sabrina would have 32,400 of profits available to pay as dividend. So that would be the maximum she could pay from that year's profits. Although having said that, we can pay dividends from our retained earnings. So as long as the profits have been made, either this year or in previous years, then we could still pay dividends from prior years as well. But in this particular year, we're focusing on the 32,400. So let's move on to part 2 of the question. Explain the advantages and disadvantages of Sabrina extracting the maximum possible additional salary or the maximum possible dividend. So we've touched on that already, haven't we? Because we saw that the tax rates are preferable for dividends. So that can be the first point we make. As a higher rate taxpayer, Sabrina will pay 40% tax on additional salary, but only 33.75% tax on additional dividend income. Let's have a look at the reference materials to see if there's anything else that could inspire us for any other comments. So we've got the income tax note there, but if we just go down a bit more, there's national insurance. So that's a useful prompt for us. So if she takes salary, then she will have to pay additional national insurance. So we can see that for salaries, so she's earning more than 50,000, so she'd have to pay an extra 2% national insurance, whereas that wouldn't be payable at all for dividends. So there's our next comment. Earning over 50,250, Sabrina would pay 2% national insurance contributions on salary, but there is no national insurance contribution on dividends. But that's not all. The employer would also have to pay national insurance contributions on any salary. So we can also comment that the company would have to pay 13.8% national insurance contributions on salary, and this would reduce profits. So that's not a good thing for Sabrina, is it? Smaller profits would also mean there'd be less tax to pay, but overall there would be less distributable profit available to pay as dividend. Now, in contrast, if she received dividend, then there would be no employer national insurance to pay on that. We can also comment that salary and employer national insurance contributions are tax deductible. So what Sabrina could do is pay herself enough salary so that they reduce the company profits down to zero. Whatever profits we have left, here we got the 40,000, she could just take that as salary, couldn't she? But as we've said, she'd be paying 40% tax on salary compared with the company paying 19% tax on any profits. So that's probably not a great idea. And then finally, Sabrina expects to be a higher rate taxpayer in all future periods. Her husband Simon has no income as he looks after the couple's 3 young children full time. Explain the opportunity for Sabrina and Simon to minimise their overall tax bill. You should consider both short-term and long-term implications in your response. So tax legislation allows someone who doesn't use their personal allowance to transfer it to their spouse, but that wouldn't apply in this case because Sabrina is a higher rate taxpayer. So if spouses are going to transfer any personal allowance to each other, the recipient needs to be no more than a basic rate taxpayer. Sabrina could think about employing Simon in the business because then she could pay Simon a salary, and as long as that was below the personal allowance, then no tax would be paid. But on the basis that Simon is looking after their 3 young children full time, it would suggest that Simon wouldn't have time to work for the business. So that wouldn't be an option either. So we've excluded a couple ideas, but so what can they do? Well, Sabrina can transfer shares to Simon. Yes, that's a relatively straightforward process, and there would be no capital gains tax to pay because transfers between spouses are exempt from capital gains tax. So that would be great. So we can transfer the shares, no tax to pay, and then dividends could be paid to Simon instead of Sabrina. Now, what's the benefit of that? Because if we pay only enough dividends that fall below Simon's personal allowance and dividend allowance, then he'd have to pay no tax at all on any of that income. And that would compare with what we saw just now, that Sabrina, as a higher rate taxpayer, would pay 33.75% tax on dividend income. Now, if the dividend income was more than that, if it went over Simon's personal allowance and dividend allowance, then the income would fall into his basic rate band and would be taxed at 8.75%, which is still better than Sabrina's higher rate of 33.75%. Now, the question did encourage us to think about long-term implications as well. So if both Sabrina and Simon own shares, then if they sold them in the future, both of them could use their annual exempt amount to offset against their capital gain and therefore pay less tax. So this would be better than only Sabrina using her annual exempt amount. And so both of them own shares means they can both use that exempt amount. Now, if they did sell those shares and the annual exempt amount didn't cover the gain, then there would be some capital gains tax to pay. So Simon would pay capital gains tax at the basic rate, which is 10%, and that would be lower than Sabrina's higher rate of tax for capital gains, which is 20%.